Welcome to the Financial Advisor Success Podcast, where you go behind the scenes with financial planner, speaker, and consultant Michael Kitces to hear stories of how leading financial advisors navigated the inevitable challenges that arise on the path to success, and get insight from leading industry consultants about how to break through to the next level in your advisory business. And now here's your host, Michael Kitces.
Welcome, everyone. Welcome to the 448th episode of the Financial Advisor Success Podcast. My guest on today's podcast is Monish Verma. Monish is the CEO of Vardhan Wealth Management, a DBA of Summit Financial and based in Farmington Hills, Michigan, that oversees $560 million in assets under management for 225 client households. What's unique about Monish, though, is how his firm goes deep in evaluating portfolios and alternative investment opportunities to find potential matches for particular client needs to attract and serve a high net worth clientele. In this episode, we talk in depth about how Monish takes time to educate clients on the different types of alternative investment products and how they might fit with their portfolio and goals, how Monish's firm conducts significant due diligence on a wide range of alternative investment products and providers to ensure they are the right fit for a client's portfolio, and how Monish finds that taking the extra time to conduct sufficient due diligence, educate clients, and explain his recommendations has led to strong client retention and client referrals. We also talk about how Monish convinces high net worth prospects, who typically already have a financial advisor, to move to his firm by going deeper into portfolio analysis and having a regular cadence of touch points than their current advisor. How Monish introduces prospects to current clients, with each side's permission, to discuss the client's experience working with his firm and investing in private markets, and how Monish interviews prospects and hopes they do the same to him to increase the chances that they will be a good long-term fit for each other, and how he is willing to let certain prospects go if they might not be a good match. And be certain to listen to the end, where Monish shares his journey of leaving the wirehouse world to go independent and how he brought 97% of his clients and 115% of their assets with him in the process. How Monish talked to more than a dozen RIA aggregator platforms before landing with Summit Financial, which offered him the opportunity to share in the profits of other firms on the platform in return for an equity stake in his business. And how Monish found that breaking away from the wirehouse world has given him the freedom to run his own business in the way he wants, including who to grow with, how to educate clients, how to price, and who to serve, while still getting back office and other support from his aggregator platform. And so, with that introduction, I hope you enjoy this episode of the Financial Advisor Success Podcast with Monish Verma. Welcome, Monish Verma, to the Financial Advisor Success Podcast.
Thank you, Michael. Pleasure to be here. Appreciate you asking me to join you today.
I really appreciate you being willing to join us today and to get to talk for a little while around all things alternative investments, which I feel like is almost like all the craze these days. So like with platforms like iCapital and Case and Opto raising like hundreds of millions of dollars in assets to support advisors that are putting like billions and tens of billions into alts. But I find like when you dig into some of the industry studies, like FPA's Trends in Investing, it's still only about 10 or 20% of us advisors that are actually adopting and implementing alts with clients. And I feel like for some, there's this still view that this is just another fad, the next fad, right? And most of us doing this for a period of time almost feel like part of our job as advisors is to like keep clients from going after the next hot thing, because usually on average that has not turned out well for clients. And then some folks at the other end say, no, like the investment world is fundamentally changing, right? Number of publicly traded companies has fallen by like 50% in the past 30 years. It was like 8,000 plus in the 90s. It's less than 4,000 today. Companies IPO later than they used to, which means if you only participate in publicly traded equities, you're like literally leaving out a material segment of the whole economy, particularly small cap that, again, like might not even IPO until their mid cap stage now. So I feel like we span the debate in the industry from it's a fad to protect my clients from to this is a fundamental restructuring of markets that we have to participate in. And I know you spent a great deal of time on this, like building alternatives into your practice, figuring out like the due diligence and the access and all the other challenges and just like how to thoughtfully use them with clients. So today I'm excited to dive headfirst into like the rise of alts, whether they fit in client portfolios, where they fit in client portfolios, and like what the advisor's role should be in bringing alternative investments to client portfolios.
No, I appreciate it. I think that's a great question. And, I would tell you that for part of my career, the first 15 or so years of my career, we were very particular about doing the financial plan and using the equity markets and the fixed income markets to solve the solutions that the clients needed for their planning. But then about 12 to 15 years ago, we really kind of thought about like, what is it that we're missing in this whole equation? And I think we kind of came up with this idea that, there's this whole other market out there, which I call private markets versus public markets. And we're not really tapping that lion's share of the resources we could bring to the table to our clients. And so when we fundamentally started looking at this, we kind of told our clients, look, there's in a very macro, there's the equity markets, there's the fixed income markets, and there's like this silo in between that I call the private markets. And there's various different types of products that are served in that mix. Some can come from the equity kind of risk profile, or some come from the fixed income profile. But the goal of those investments is really to kind of give you a return of model that you need based off the risk assessment we've done, and to give you some agnostic risk against the public markets, and to give you cash flow or protection like you would kind of traditionally see coming from the fixed income markets. And it takes a lot of education for a lot of clients to kind of understand that concept, because a lot of times when we're getting referrals there, we're seeing a very similar 60-40 or some version of that coming in, but they're saying, well, is there anything else that I'm missing? And to me, I'm always of the answer of maybe. Depends on your risk tolerance, your education level of how you would like us to educate you on this space. Because to me, it's all about the component of us educating our clients prior to using any investment products, and then seeing which right fit of those investment products fit what their needs are, and put them in that proverbial third basket for them. And I think in our hope and our goal, which we've had some success in, is to really start with the plan, show them the education second, and then lead in with, here are the products that kind of fit the goals that you want us to succeed at. And that way we kind of really get to the best solution of putting together a dynamic portfolio for our clients. And so they can see the success as they go in the markets, they can see the risk band that they're in. I think a lot of times clients come and feel like when you start talking about private markets or alternative investments, their minds directly goes to investments that need to be held for 7 to 10 years. They have a lot more return, but they also have a lot more risk. And do I really want that risk, that return? And sometimes once we get through our process of educating them on the different types of investments that could kind of we can put together to make that sleeve of alternatives, they're like, okay, well, I kind of get this now more so than before, and it's not what I thought it was. So the perception is one of the first things we have to kind of break through, of what they think alternatives are, or what is the private market sector.
So there are a few things that strike me as your as you frame that. One, there is to me kind of this I don't know, like funny double-edged uh interpretation of, clients come in and say, like, is there anything else I'm missing, right? You're here to give me a second opinion. What else should I be doing that I'm not doing in my portfolio? That there's both perhaps a kind of literal, what am I missing? Well, a significant portion of the economy actually happens in not publicly traded markets. Maybe we need to be looking at whether you're participating in that. And literally, like, okay, there's now a whole shelf of products that help to solve for that, that you don't typically own in a traditional 60-40 portfolio.
Right.
There's a product answer and there's like a meta markets answer. But I guess, how do you even think about it between those, or when you're positioning with clients?
Well, when we kind of start looking at their portfolio, we do a lot of deep diving and understanding of what is it that they're really wanting to understand or know. Sometimes they think they want to know, am I okay? And then how do I define what is okay? And then we start with there and say, well, what's your risk profile and what is your goals? What are your needs? A lot of our clients are coming to us already wealthy. So our job is really to keep them wealthy, right? It's not, can I retire at this year or this age with that amount of income? It's kind of like, I've made a reasonably successful amount of wealth. And now my goal is to try to figure out how to live off of it, protect it, grow it, gift it, be philanthropic with it, and all of those goals are things that they come to us for. So when we start talking about their risk profile, we start to figure out which part of their money is going to be long term, what part of their money will be intermediate term, and what's immediate. What do they need right now? And sometimes that's going to come from maybe a monetization event that's going to happen in their near future. So we start structuring a lot of their things in the estate planning world and the insurance world accordingly. But when it comes to the allocation, we start saying, at your size of portfolio, have you been introduced to the different concepts of private markets, public markets? And they said, well, sometimes clients will honestly say, I don't know, but I don't really want to get there. And, I don't want anything that I have to lock up for a decade. I said, yep, I understand. That makes a lot of sense. But let me walk you through it if you're open to it. If you're not open to it, no problem. But if you are open to it, I can walk you through it. And I want to share with you how we've used some of these investments in other clients' portfolios to give them a result that's somewhat similar to what you want to do. And then we start talking about the different private market investments, or the different alts, I should say. What are structured notes? How do they work in a portfolio? What are the pros and cons? What's private credit, and what does it do, and why does it exist even, right? What are real estate investment trusts or REITs, and understanding that a little bit. And then we will talk about what are hedge funds, and what are um, uh, private equity investments, and even commodity investments. And we walk through kind of all of the kind of variations of different types of investments and the pros and cons of each, and how they would fit a client portfolio. And then we start engaging, and the client's engaging with us and saying, well, I kind of really understand this, but I don't want to use that because I heard from a friend of mine that can do this or that for you. And we start kind of getting and honing in a little bit more on what's the available suite of options that we should be looking at for our client from their comfort level. And then we start to make sure we have a level of education with them and say, let's talk about these a few times, show you how they work, how they fit, what they do, the pros and cons. And then now we've gone from the whole lineup to kind of maybe a core few that they're comfortable and open to kind of dive deeper with. And then we create a model at some point when their comfort level's there, so they can see, okay, this is how it's going to fit. Here's where the money's coming from. If it's not coming from an event, but it's coming from a different part of their portfolio, we want to be mindful of how we do that for taxes if it's after tax money. And then we start building that plan out, and we tell them that sometimes it takes time to build it out. We don't sometimes do it all at once. And then here's what we should be seeing out of it in a volatile market. You should be seeing this out of this investment. So then we're really kind of holding their hand along the way to make sure they understand that. Now, some clients will come to us if they have an ownership interest in a company, like if it's a privately held company. They get the fact that's a private market versus a public market. So they're at a different level potentially on that education curve that we like to call it. But at the same time, they kind of know their business, but they don't understand how it fits in the ecosystem of private market. So it's a lot of education up front, because there is a lot of product out there. But the goal is really to make sure that we're using the products for a solution that the client has a need for.
So I feel like in some ways this gets challenging or overwhelming, even including for advisors, because there's so many products and ways that this can come together now. So can you walk us, I guess just walk us through a little bit more. You mentioned a couple of different, right, so like product categories, verticals, or like structured notes, private credit, REITs,
Yeah.
hedge funds, PE,
Yes.
commodity. Like is that actually how you segment the marketplace for clients when you're explaining it to them, or how do you explain the different range of options when you're talking to clients?
Yeah, it's just like that. I talk to them about what are equities, and I kind of reiterate to make sure they understand what a global versus international versus domestic are. I kind of reiterate to them, and so they understand what the packaging, the mutual funds versus ETF versus separately managed accounts. I do a version of that for a fixed income, and then I go into the alternative markets and talk to them a little bit about what is a structured note, how does it work. I walk them through what is a hedge fund, what is private equity, what is private credit, what are the nuances of each one, and then I do the same thing for the real estate investment trusts, and then I just walk them through, like that's kind of like the level one, that very macro approach of what each one does and how it works. And then I said, does any of this resonate? Have you heard about any of this before? Have you thought about using any of this before? And sometimes clients will say, if you looked at my portfolio, I might have some of that, but I don't really know know what it means. And we'll explain to them what they currently own so they understand it and say, and then the question usually comes from them is, does that fit for what you're talking about? Is that one that you would use, or is that one I should be using? And I walk them through the pros and cons. Sometimes that's come around like, what is an opportunity zone as an example? Like, is that a private investment or is that not a private investment? Because they've heard the buzzwords
Yeah.
sometimes. So explanation and education on all of those at a macro level. And then as we kind of do their financial plan and dig deeper into seeing what their goals are, then we start kind of coming up with a plan. We may not use, obviously, all the time all of those investments, but we'll kind of say, here's the ones we feel would be a good fit initially for you to start with. And we'll say, like, if you have a $25 million portfolio, our goal for you to, because of our risk profile and our introduction conversations, is you should get to maybe 20% in this space. And let's walk through what that looks like, where it comes from, and which products we should use for that, and what does it do for the rest of your portfolio. And then they feel comfortable knowing that there's going to be a plan in place, and then we'll know which products we'll use in that plan, and then we'll start dissecting those out, and it'll take us time to build out that portfolio. Sometimes we'll say, okay, now we know the footprint of your overall allocation, we know what percent we're going to use in this kind of sleeve. It's going to take us 3 to 5 months to completely fill it, because we want to walk you through each one and make sure you're comfortable with it, and then we'll dollar cost average into those if we are able to do so. So now they know, okay, I'm going to do 20% of my $25 million portfolio. That's how much is going to go in there. We try to use 3 to 5 different types of versions of the investments to keep them well diversified, even within the sleeve of alternatives. And then we walk them through which ones, and we start adding them to their portfolio, and educating them along the way. We have to let them know, are they going to get 1099s or K1s? And we don't want to, ideally, we don't want to be the first time they see a K1, but if they are, we want to educate them. What does that mean? Right. And then with a lot of times what we'll do is we'll include their other trusted advisors. If they're working with like a CPA, we'll have a call with them and their CPA, and let the CPA kind of walk them through, what's the tax side of some of the alternatives. What do they see from some of their other clients? And why do they use them in those kind of portfolios? So now they get the kind of the tax buys, but they're also getting it from a trusted source that they've been using for a while, if this is still a prospect for us. And then if they need to, and we always offer, we offer references and say, if you're an entrepreneur that is going to go and sell your business in 2 years, we'd like to offer you some of our clients that have been in your boat and have been working with us for 5 or 7 or 10 years, and you can have a conversation with them. We never disclose the client's name. We ask the client after they've given us permission to share their name, and then a lot of great conversations have come from our clients that have to our prospects, and that's really where sometimes the real value comes in for them to understand what they're using, why they're using it, and how it works.
So you don't disclose the new client's name. I guess I'm trying to understand which way it goes. You don't disclose the new client's name to the existing client. You get permission from the existing client to share their name with a new client.
No, I will say, okay, John Smith, you're a
Okay.
new referral for us. Would you be open for me to share your name with a couple of my clients to make sure it's okay for them that they speak with you?
Okay.
So then I'll go and call my client and say, I have a gentleman, his
Oh,
name is
interesting.
John Smith. He's kind of engaging us potentially. He'd like to have a conversation with someone we've been working for with a while. Would you be open to have that conversation? And they'll
Okay.
say, sure, no problem. Give them my cell number, or connect us by email, whatever method you want. And then I'll call back the client, the prospect, and say, I'm going to be connecting with so and so. They've been a relationship of ours for a while. They've allowed me to release that name to you. I'm going to connect you by email, or if you'd like to, here's their mobile number. You can call them and ask the questions you'd like. So that's typical, and that happens 50 or so percent of the time. Sometimes they're like, no, you were a referral anyway from someone we know very well. So in my eyes, that is our reference. So we don't need to call
Yeah.
out the references that you're offering, but the fact that you have them is really nice. And we appreciate you even considering giving us a name like that. So
No compliance concerns for you around that structure?
no, we're never releasing any information about the client
Right.
without permission from the client directly. We're
Right.
asking the permission from the prospect up front if we can release their name. So if they decide they don't want to do that, which has really happened on a very rare occasion, then we won't honor that. We won't ever name drop or do any of that kind of stuff. But if there's someone that's kind of engaging with us, they're going to end up seeing some of our clients. We do events periodically where we invite clients, we invite prospects, they engage with each other. Some businesses have happened because of those kind of events. So at some point they will see each other, but it's strictly kind of a protocol where some of these clients have already told us, hey, Manish, if you ever want, you can just use my name. I was like, I appreciate that, but I'll never use your name without your permission.
I'm curious to hear more about how you actually explain and frame up some of these uh, alternative products, alternative vehicles to clients. So when you get into realms like structured notes, private credit, private equity, I mean, how are you actually explaining to clients like what is this thing that
Yeah.
you're
Yeah.
that you're introducing to me? Like what have you found works to just to communicate what these are?
So one of the best ways I found is to show them examples. So if I'm going to suggest, and I feel like at some point private credit might be a good option, I will use a private credit investment we're currently using for other clients. I will email the client. This is the private credit sample that you should take a look at. Here are the pros and cons of private credit. How does it fit in your portfolio? Which side of the market of your fixed income or equity should you kind of think you're bringing money to this? What is it providing you? Here's some bullet points and some documentation on this investment. And now let's have a conversation. So I've given them the opportunity to maybe read up a little bit on it, and then we'll have a conversation and say like, okay, this is interesting. I like the distribution rate. I like there's a little bit of growth. I like the background of where where is this being sourced, the revenue and the cash flow. Like they're lending to people or institutions. I understand all that, and then they'll have maybe a point or two conversation. Then we'll talk about, is this the one that's the right fit for me, or is this a good? I said this potentially could be the right fit for you, but there's many options, and they have different kind of styles of how they would work. But this might be the first baseline of the first tranche. If we're going to use X amount of dollars in private credit, and we know that we're going to do two different investments in it, do we want to do it all with one manager, or we might use two managers? This is the first one we might use. And then we'll talk about structured notes, how they work, how they operate. We'll send them like a lineup and walk them through what the notes are and all the uh, lingo of the notes and the barriers of what's a buffer and a barrier and all that. And then they'll say, okay, I get it. So what would happen to the note? So I'll explain to them, like, if we had bought this note a year ago, this is what could have happened if they wanted to call the note, and this is what happens when what call means, and this is how the note should act. And at the downside, this is what could happen. And then we can, if we need to, we can try to sell the note back to the market, back to the company that's putting the note out. So I'll walk them through all that, and then and if they do decide to go with a note, we'll start with a very small amount, and then so they can see it on their statement. They can get an understanding of how it operates, because they're not typically accustomed to daily pricing sometimes of an instrument on their portfolio, or how it looks on their financial plan or in their portfolio review. And then we'll work our way through that. And sometimes we're doing that for two or different types of investments in the same alternative world. So as you can see, Michael, there's a lot of education sometimes involved. If there's a client that's kind of wanting to know more and wanting to understand how we can use this in their portfolio, but we definitely take the time to teach them and understand them, teach them and for them to understand how they work in a portfolio. And then they want to know, like, what do we do on our discipline to make sure these are still relevant investments and instruments to use. So me and my team, along with my back office, we're always reviewing and vetting and scanning and making sure that what the team is supposed to be doing, they are doing. Are they aligned with what metrics they've set out for us? Are they deviating from it? Why are they deviating from it? We do manager calls to make sure that we're talking to the people making the decisions, not just the wholesalers. So we do a lot of that. So I have a co-CIO on my team who helps really do that back deep dive information process. And then we have a team in New Jersey that also is reviewing it. So we have a pretty healthy due diligence process on the investments that we work with.
So I'm struck in hearing this relative to this, how a lot of advisors implement with clients, where there's I don't know, quote unquote, traditional approach, which essentially is, clients come in, they tell us their goals, needs, and circumstances. They tell us their risk tolerance. We construct a portfolio that's appropriate to their needs and goals and tolerance. And we come back to them. We say, like, this is the portfolio I've crafted that I recommend for you. And generally, like, they're kind of in, or they're not. Maybe there's some light customizing for circumstances, but usually clients don't really get to say, like, well, I heard mid-cap growth's kind of funky, so I don't really want that in my portfolio. It's like, no, we own a diversified portfolio. Like, this is one of the things that we own. Whereas what you're describing here, just to me, it feels much more conversational. It feels much more gradual, right? Clients aren't going to end out in a full allocation of traditional and alts off of a like one-time upfront investment portfolio recommendation. It sounds like they may get there over time. Their portfolio could morph over, I don't know, months or years as you work with them and they decide which alts they're comfortable with or not. And clients are all going to end up being somewhat different because of the things that they said yes to or they said no to. Is that
Yes.
like a fair characterization of like
It's
how this is different?
it is a fair characterization because I work off the belief that we are here as a fiduciary and have a responsibility of educating, and part of that education is to get them to a place where if they decide they want to pursue having alternatives in their portfolio, our responsibility is to confirm to them what that means, what they are, how they work. We get very granular. We might have sometimes, depending on the size of the relationship and the amount of education involved, 3 to 6, 7 conversations before we make our first investment in an alt for a client. And I think we get a lot of stickiness with our clients and a lot of trust built up really quick early on because they really feel comfortable with the fact that we're spending the time with them and we're educating them. And if we added a new option to this a year later, we're still going to go back and educate them on it. But it is very conversational, and it is very kind of customized to a point of making sure that we understand where their level of understanding is of the investments we want to use. I think that in our industry, the communication component to the client has to be much more robust than I think some traditional advisors think. Where if we get a client coming in and they're like, "Here's my allocation. What do you think I should do?" and we send them an allocation without a lot of communication behind it, we've now leased a client for a while. But if we spend the energy up front and the time that I believe we need to, and that each client's different, to edge and to invest in that relationship, then we have a relationship. And then we have an opportunity to have a long lasting, multi generational relationship with very, very integrated opportunities for referrals. And that's why I tell my team, I really not a I don't care if we bring on 7 relationships or 20 relationships in a year, it has to fit. We have to be having some level of alignment with the client. We have to make sure that we can resolve all of the things that are around them, like whether it be either their estate planning or their insurance planning or their need or wants of having more than just a 60/40 modeled portfolio. And it takes a lot of time for us to have that education process. So I think that it's probably the slow burn of really building that relationship up front with a lot of capital up front of time. But I think that if we know or they know, like if the fit's not there early on, we know that early on, right? So if that happens, then we know early on, and we're not shy about letting clients know that we are having an interview process. A funny side note is a new client that came on last year was a referral from a family member of theirs, and they were about to monetize a business. And I met them for lunch, and his wife wasn't very engaged in the conversation until I said, this is an interview. Like, this is you interviewing me and me interviewing you to see if it's the right fit. I would encourage you to interview another 1 or 2 other advisors. And she kind of like turned and said, wait a minute. we're supposed to interview you, and you're kind of seeing if you want to work with us. I'm like, absolutely. This should be a mutual relationship built on the fact that we're going to expect to trust each other and grow together. And when you do have your events, you'll have your capital coming in, and I'll be somewhat responsible for making sure everything's being managed along with you for your retirement. Totally different meeting for the next half hour. At the end of the conversation, she's like, "So what do you think? Do you want to work with us?" And I said, "I'd be happy to if you'd like to, if you want to discuss it." And she didn't even look at her husband. She goes, "We're good. Let's proceed." Right. So I think that with this conversational type of approach to a new opportunity happens, it takes more time and energy, but you can get to the fact that you've gotten a commitment from that client to want to work with you. And then you build off of that for all these conversations about putting the portfolio completely together over a period of time.
How do you evaluate the trade-offs as a business of is this actually worth how much additional time and effort it's taking to implement?
That's a great question. And, so our clients that we look at to come in and work with us typically are between 5 and 50 million of assets that we're working with.
Okay.
So when we're looking at that kind of level, there's a level of we're almost being like graduated from someone else to you, right? I mean, the old adage of like the reason we're talking to you is because you have an advisor, right? If you didn't have an advisor, that means you may not have the capital to have an advisor. So we're basically at that point where most all prospects coming to us are already working with someone else, and they feel because someone mentioned to them that they've had a good success with us, or they feel like we're very communicative to the relationship for someone else. That's why they're coming to us in the first place. So when I ask people and say, well, we can ask the sample questions of, well, can I see your investment policy statement or your financial plan? 9 out of 10 don't have one, or it's not relevant. Relevant meaning it's at least updated in the last 2 years. And we talk about your goals. What's your performance? Is it within your risk profile? What is your risk profile? They don't really have a good answer. And I said, so, what's your communication cadence with your advisory team? How do you know what's your communication cadence? They're like, well, we hear from them, I guess. With what cadence? Is it monthly, quarterly, semi-annual? What's your cadence? They're like, we don't really have a cadence. When we call, they pick up. So, we have a very disciplined approach of having a cadence with our clients. And when we bring on a new client, and as I mentioned, we're not bringing in 50 new clients a quarter, right? Our goal is to interview clients and see who we want to work with long term, who want to work with us long term. If they're coming in at that 5 million, is there going to be an event in their future, an inheritance in their future? We're doing a lot of work to see that there's a fit, because when we bring on a client, I don't want to lease that client for 1 to 3 years. I want to have that client for the rest of their lives. And I want their children and their grandchildren as clients. So the work that we put in up front, I I think as you communicate it to someone else, it sounds like, wow, that's a whole lot of work. I think that's table stakes to build a relationship for a new opportunity to work with us. But would we spend that kind of time and energy if it wasn't within that scope of 5 to 50 million? Now, is it, at this point, we are looking at like that 5 to 50 as an average kind of pool of capital that we can work with, because it does take time and energy to build that rapport after they've committed to work with us.
Well, it strikes me in that context, is as you highlighted, like most of our clients who have the financial capital to work with us almost certainly are coming from another financial advisor already, which means I have to differentiate in some way about, right, what can I do for you or bring to the table that you're not getting from your current advisor? Because I'm assuming you have one, given your resources, and I know you are a meaningful financial opportunity for my firm if we can win you as a client. And so I like, there's almost a piece of me hearing this, uh, a lot of advisors I find in practice struggle to keep their top clients because it's hard to put in as much time as it takes to keep those relationships with those like 3 to 5 top A+ level clients, because I've got so many other clients to serve as well, and we're busy in our practices. That one of the distinctions when you start with our clients are 5 to 50 million, and we're pricing at a level where I know I'm going to be able to spend this much time, and I'm even choosy about which clients to take to make sure I'm going to get clients that are worth spending this much time, that you're just like, you're you're building a business that's simply from the start going to have far fewer clients per advisor, which allows you to spend far more time per client, for which they can remunerate you appropriately at 5 to 50 million. And so the math just works, and you end up winning away clients from other advisors because you're investing more time into the client relationships, because you're focused on clients at that level. And so you're built to invest that much time into each client relationship.
Exactly. And when we have these clients, there is at some stage an education process of what kind of referrals we would like them to provide us. And so they know, like, if it's a family member, we'll take on any family member. We've had a lot of them come to us and say, can you work with my son or my daughter? Obviously, they don't have our resources. I said, you're a client. They automatically become a client. We will never turn away your son or daughter. But then they also will say, and I've heard this many times, hey, I have some questions. It's my wife's best friend, but she doesn't have the resources that would fall within a number that you would want her as a client. But can I ask you to speak with her on my behalf for 15 minutes and answer her questions about a portfolio that she might be managing for $3 or $4 million? And of course, we'll spend the time because you're our client. We'll do that, and we have really good relationships with what their clients know. Like when they precursor their, I know this is not a good fit for you because they have under 3 or 4 million. I know that I've done a good job to educate them of what I really am looking for, which is the 5 to 50 million. And that's important for us to let them know. Like when you give us a referral, we love it for it to be in this kind of space unless it's a family member. And so we may not get 50 referrals, but when we get them, we get the ones that we really want and with the ones we're really interested in. And I've been known to be uber A type personality, like a lot of my colleagues who might listen to this podcast. But we'll sink our teeth in, and until a prospect tells us I'm okay, no thank you, we'll continue to prospect them. I mean, we have one of our best clients who's referred us a ton of clients. He was an off and on again prospect for 10 years before we landed him. And I'd ask him every occasion, are you okay for me to continue to follow up? Are you still kind of on the radar that you're making a decision? And the answer was always, yeah, I'm getting your information. I like that. I like that you're checking in on me every so often. Please continue to do so. And at some point, we did get them because he's like, wow, I either have to sign up with you or tell you not to, call me anymore. But I really like the information you send me, and I think I'm going to have to just, go with you. I'm like, well, I don't want you to feel it to be a detriment because you're
Yeah.
making that decision. But he was like, no, the level of persistence that you've shown respectfully over the course of time. I said, well, just so you know, it's been 10 years. He goes, I can't believe it to be 10 years. I felt like 2. I go, here's my first note.
As the person on the other end who's been calling on you, trust me, it's definitely 10.
The first time in my first note that I've called on you was this date. And he started laughing. And so, obviously not every client takes that long, and especially if they're referrals, but we've been known to, be respectful and make sure you have someone who's in that range, in that 20, 30, 50 million of assets. Um, it makes a lot of sense to do the hard work to the client and do the education to do the client well and serve them well, because there's a lot of people who would love those clients, but they maybe don't want to invest in all the work and communication to keep that client.
So then help us understand just the state of the advisory firm as it exists today. Like how many clients, I guess, however you measure clients or households or families, like how many clients, what's the asset base, what's the revenue, like just help us
Yeah.
understand what this adds up to that you're executing on.
Yeah, so we are doing about 3.5 in production. I have a team of 4 people, including, and then myself 5 in our office in Farmington Hills. We have got 200 people we share in the back office in New Jersey: tax attorneys, compliance, strategists, planners, and
What's the firm in New Jersey?
Summit Financial. We're a DBA of Summit, so I'm Vardhan Wealth Management, and we're doing business as from Summit Financial as our back office.
Okay. And so structurally, like are they a corporate RIA structure and your IARs of their corporate RIA?
Yeah, so I'm a equity owner in Summit Growth Partners, and they're an
Okay.
equity owner in Vardhan Wealth Management. So I sold a minority stake, and I felt it to be like a diversifier. So now I'm an equity owner in all the other DBAs that are in Summit Growth Partners. So we collaborate. We meet a couple of times a year together. We collaborate with each other. I have calls with other advisors. They do all our IT and our I do all my own marketing, and we run our own office space here. But they charge us a small fee to be a member of the Summit Growth Partners platform, where we can now share with all the resources. We have CIOs there. We have a whole insurance group there. We use them pretty actively. We use their estate planning attorneys to review documents for our clients pretty regularly. We have our custodies with Schwab and Fidelity, but we have our relationships through them, so we have back office support if we need help. So we really leverage that platform. And then I have a team here that's really client facing. We have a space here of 6,000 square feet in Farmington Hills, Michigan, and we're growing by adding advisors to Vardhan Wealth Management right now to bring in other advisors that want to leverage our platform, because we have a great team. And as we need to grow, we continue to grow. I always have 2 or 3 people in the back office that I can go and call from people I've worked with in the past that you may want to make a switch. And then we have 12 different advisors in different stages of conversations that we're talking to, that we want to bring in to grow our brand going forward.
So can I ask, like, what is the revenue sharing arrangement to Summit? Like, just how
Yeah.
does it work? How does it price for you guys?
Yeah, so they charge us like 5% to be on the ecosystem. I sold 20% of Vardhan Wealth to Summit Growth Partners, and in return, I got a multiple upfront for that, and I also get dividend payments because I'm an equity owner at Summit Growth Partners. So if I make $1, I basically I get 80% of that dollar, and that's what my revenue would be. So our gross revenue is 3.5. So I get 80% of that. And then out of that 80%, I pay my expenses, and I run a pretty lean ship. So our payout still is, in the high 50% range after the 20%
Okay.
ownership is done.
Oh, interesting. So the bulk of the arrangement is not I pay them a percentage of my revenue. It's they literally own a percentage of my firm
Yes.
and participate in the economics of the firm. But I'm presuming that, like, I have to transition shares in part of the deal. Like, just that's how it works, so that they get the economics they need to actually run their business and
Well,
and
well,
be financially viable.
so to become a Summit Growth Partner, that's a choice. If they said, if you want to come to Summit Financial and you want us to work with you, you can choose to sell part of your business, or we can just give you economics, and it's a 90% payout, and the 10% is a cost of doing business with us, right? Whereas I opted for the economics of selling a portion of my business,
Okay.
because I wanted to diversify and invest in all the growth of all the other advisors that are also growing their businesses. Now I'm getting participation in their investments, and their growth, and they're getting an opportunity to grow in my growth. So it's kind of a win-win in my book. And as we talk more about like the process of going independent from the wirehouse, I'll walk you through like I talked to 16 different aggregators before I went and talked to Summit Financial and learned about this model, and tried and split it apart 5 different ways before saying, okay, I'm committed to it. Because when I was going independent, I never fathomed to sell any part of my book early on, or my revenue early on. But I will tell you, when I educate clients on how my structure is, they really resonate with the fact of, okay, that's great. So you're a RIA in Michigan growing advisor wise, but the fact that you're part of this ecosystem of Summit Financial and Summit Growth Partners, and you have this really big bench behind you, per se, with all these advisors all over the country that you consider your colleagues, and not your competitors, but your colleagues. So you have a big mind trust, a brain trust that you can tap into if you needed to. And I've partnered with some people in the past when they've asked, or if I've asked them for specific cases that they might have a higher level of talent for, depending on the circumstances. It just brings out a new dynamic to winning the client that you want to win.
So you get dynamics of, like, needing an agreement about how much you get paid in your own business when there's split ownership? I mean, I'm just otherwise envisioning this world where like you can you can pay yourself a quote unquote very generous salary and kind of minimize profit distributions to owners since you get all the salary and they get a percentage of the ownership. Like, do you have to get into a world of determining what reasonable compensation is and how to split the dollars between owner salary and dividends to owners?
No, because basically they get 20% of the gross. So
Okay.
yeah, so they get 20% top line.
Okay.
Yep.
Okay.
So that way you can pay yourself whatever you feel like, or take distributions of whatever you want.
So it's not a like common equity shares essentially that they own. It's more of like functionally a preferred style structure where they're getting a certain percentage of revenue off the top tied to their ownership.
Correct.
That's the deal.
Correct.
Okay. So I guess just I'm curious, since you were diligencing all the different aggregators out there, like how do you assess the landscape? What else led you, I guess, to Summit or away from others? Like what was
Yeah.
working and not working for you?
Yeah. So when I went, I talked to about 12 to 14 of the ones. And the first level was when I knew I wanted to go independent. I kind of started taking the calls I used to not take. Right.
Right.
So that was my first. And I talked to them and I walked through and I talked to their business people and their CEOs and kind of mindset wise, well, what are they doing and why are they doing it? And then I kind of said, okay, I'm going to go to another set. And on my own, I kind of researched a few and then reached out to them. And then what I did is I used to work with a consultant in New York and reached out to them and said, here's who I've talked to and who else do you see out there that maybe I haven't kind of been on my radar that I should talk to I'm doing my due diligence. And so they connected me with three. Summit was one of them. So I didn't find Summit on my own. I kind of found them through this consultant that was kind of telling me, here's other people you should talk to. And so when I reached out to all of them, the three, um, I just had a really good I resonated really well with Summit. I talked to them. I was the first wirehouse advisor that transferred over to Summit. So they've been around for 42 years. They have a background of planning. They're basically in the New Jersey, New York kind of area with advisors. But then they brought in a new CEO about 10 years ago that was going to basically build that brand out to be more of a DBA brand all over the country through Summit Growth Partners. And that's where I was kind of a year in. I was probably one of the first people they were talking to like a year in, and really resonated with the people that were there. It was kind of one big family and they were growing together as a family. So I met with them, I talked to them many times and just felt the right fit. I still talk to the other two, but I felt like everything else felt corporate when what I wanted was a partner. I didn't want to work for someone. I wanted to work with someone. And that's what I found in Summit. To this day, I still work with them. I still have a monthly call with the CEO. He calls me sometimes just to check in and say hi. And I do a lot of the calls for advisors that are interested in joining Summit. They call me and check in with me to see how my experience has been. I hosted two of them yesterday in my office who are going to be going to New Jersey to meet with Summit today. So it's kind of like a big family, and we want to be mindful who we let into the family kind of thing.
So now with the resources that Summit gives, what are the actual roles of the people on your team in the Michigan office?
Right. So the people in my office, I'm the lead advisor and the owner. My goal is to bring in new opportunities and vet new clients that we're going to take on, service our existing client base, and then obviously run the office. I have a COO that's been with me for a long time. She's very meticulous. She's an engineering background. She runs our team. We run 10 a.m. meetings every day, and she runs them. So she's in charge of running the office, running the team, and she's also in charge of doing all our paperwork for alternative investments for all our clients.
So what are the 10 a.m. meetings?
Every morning we get together in the boardroom. We talk about what's going on. We walk through all the clients that we're talking about for different specifics. My other advisor on the team, who's been with me for 15 years, he started with me as an intern. He has no responsibility to bring in clients. He has every responsibility to talk to our clients, to send them the inverse conversation emails that we might be talking about some of these alternatives. We're talking about alternatives. He's doing all the due diligence for all of the investments we have, so he's spending a lot of his time on that. He also is head of planning, but we have another planner that we brought in, so he's in charge of making sure all the plans are complete and they're aligned with the goal of the client. So he's having a lot of conversations with clients and making sure that we're up to date on our planning. And then he does have education calls if they have questions about some of the investments. I do a lot of that for the newer clients. He does that for the clients that may have been with us for 5, 10, or 20 years. And if we're introducing a new investment to them, do the due diligence of talking to them. I have another lady on the team whose name is Jean. She was a CSA that I knew in my past from a wirehouse. I asked her to come join me 3.5 years ago. She came over here from another RIA. She's done a great job. Just this year, she's been promoted to head of insurance. So we've been doing a lot more insurance in the last 5 months than we have probably in the last 10 years combined. So I needed someone to just support the insurance role. And then
And what kind of coverage or policies are you writing?
So we work with Mass Mutual through Summit as well. So we can work with Mass Mutual, and then we also have 23 other carriers that we can work with through our insurance group. So when we're doing the financial plan and evaluating what the goals and needs of our clients, we're reviewing their insurance. If their insurance is appropriate and fine, we let them know it's appropriate and fine, and we make sure that we've checked that. But if they need something more or less, replacement, modification, adjustment, we make those recommendations. And if they don't have an insurance person they're already working with, then we always let them know we can provide that service to them as well.
But
Uh,
what kind of coverage? I mean, are you writing long-term care insurance policies? Are you doing disability insurance? It sounds like
dis-
your clients are usually not in the life insurance income replacement realm.
yeah,
They'll
yeah,
be okay.
yeah, disability, long-term care, but we're also doing a lot of the personally owned life insurance policies for if they're gifting to their kids and they don't need the capital, we're showing them different ways that they can use insurance if they need to. Second to die life insurance for estate planning purposes. We're doing business insurance planning for buy-sell agreements. We're reviewing their second to die and first to die insurance. If it needs to be adjusted or modified, we will do it. A lot of times we review it and it's appropriate for what they need, but they need someone to review it because they've never had it reviewed in years. So we review it and then we make sure it's appropriate for the plan, what they're doing. Sometimes, if they're going to have their unified exemption credits, which is supposed to sunset at the end of the year, if they're beyond that, for some of our clients, their net worths are in the 50 plus, 100 plus, 200 plus million range. We're working with estate planning attorneys to make sure that we can shelter as much as we can for the unified credit exemptions. And then if they need to, if we know there's going to be a tax bill, then we're going to do a second to die life insurance policy to alleviate some of that tax bite down the road, given the size of their wealth. So there's 5 to 7 different reasons why we would do and review insurance, but we look at it from the eye of consulting, not from the eye of how do we sell a policy.
So I guess as I'm curious in that realm, I see a lot of firms as they move up market into higher net worth, like shedding insurance and brokerage licenses because they want to position as fee only and not doing any of the brokerage or insurance products. So I guess I'm just curious, like, is that an issue for you? Is that a concern? Is that not a concern? Like, do fees versus commissions and fee only come up with your 5 to 50 million
Yeah.
clientele?
So we are 95% fee based. So all of the asset management we do is all
Right.
fee based. The only commissions would get is if there was an insurance component to the equation. So all our
Okay.
structured notes, all our alternative investments, everything is fee based. We don't do any commissions on those.
Okay.
So only thing that we would have a commission on if there was a solution that was needed would be on an insurance policy.
So that's like your dividing line is
Right.
absolutely no commissions on the investment, like the investment
Right.
product side of the ledger, as it were.
Right.
That's kind of equalized fee based across the board.
Yeah, we want to be purely consultative on that. It's all fee based. We've
Okay.
had clients come to us and say, "Well, I want you to charge me a plan base." We had a referral come in with $7 million. I want to you just charge me a plan fee, and I said, "We'll do the planning because we're going to do the planning anyway. But if you don't want to become a relationship with us, we that's not a good fit for us. And they're like, oh, so you don't want to work with me? I'm like, well, I want to work with you, but I want to work with you in the realm of what's the right fit for both of us, not just for one of us. And so unfortunately that's a good fit for you, but it's not a good fit for us. So we would pass on that. And honestly, last year I think we passed on 5 or 6 relationships that we could have had, but through the process of doing the interview, it just wasn't a good fit. So we decided, we let them know that unfortunately this is not a fit that we can pursue, but we hope that you decide on a good fit with maybe one of the other advisors you're talking to. So it's a very consultative approach is what we take. It's a lot of education. You asked the question of how many clients do we service? We service approximately about 225 households, and our goal is, to make sure that every time we add a household to that relationship, we are going to be able to educate and add value to that relationship. So we define that to the client when we sit down with them and say, this is what our value proposition is. We show them. I don't show them a pitch book. I have a process and procedure manager, protocol book of how I run our team. A lot of questions come up of, this is interesting. What's this 10 a.m. meeting about? And I said that the meeting's really a revolving of our own communication. One of the reasons we could survive through COVID as a team is because we had a 10 a.m. call and a 4 p.m. call every day.
Right.
And the 10 a.m. call was about process procedures. What do we talk about clients? And the 4 or 4:15 call was about checking in to make sure how everyone's mental health was. Sometimes we'd have a cup of coffee at 4:15 together just to check in with each other and make sure everyone was fine because they were all at their own homes. But our office is open for clients to come in. We're an in-office 5 days a week kind of office. I'm in unless I'm out meeting with clients or meetings. My team is in every day. We run it, and the clients are free to come in. And sometimes a client will come in when they have a need or a want, and sometimes they call ahead, and sometimes they don't. But
Yeah.
at the end of the day, they feel we're part of we're part of their family. We're part of their circle of who's going to take care of their family, and we get calls all the time about various things. I'm deliberating for my son to go to Berkeley versus the University of Michigan. What do you think about that? You've met them. What do you feel is a bit better fit for them? We've been brought in on those kind of conversations.
And then what's the overall AUM for the business relative to this
Fi-
client base?
560 million in assets right now.
Okay. So now take me back to the alt side again. Now that we just got better context of over $500 million of AUM, 225 households, kind of core 5-person team plus the Summit resources. So coming back to the alt side, so you talked about a wide range, right? There's structured credit, there's real estate investment trust, there's hedge funds, private credit, private equity, commodity, opportunity zones, et cetera. Just in practice, what are you using most often? Like, are there particularly categories that are
Yes.
very common for you? Are there some that are much less common for you? Like, what's actually getting used?
Private credit is one of our big ones at the moment that we're using in practice. We are also using hedge funds. We are using private equity. So I'd say those are kind of the more common ones. We're not doing a whole lot of structured notes at the moment. We have done some more of those in the past, but we're not currently using a lot of them at the moment. But that would be kind of like the roundabout, like and then we do some private placements when we do have opportunities to do some private placements that come to us a lot of times through Summit, and then we'll evaluate those to see if there's a fit for some of our clients.
So what led to structured notes less and some of the others more?
Yeah. I think we had a little bit of a shift in the market where we were using some of the notes. We have 4 different platforms for notes that we can use. Um, when we were
Which are what? Like, what do
well,
you use?
there's the case and the intercapital options, and then there's Halo, which is the one that we were using quite a bit. Which is they're tremendous platforms, but a lot of them are sensitive to the market and how they price their notes and how the
Yep.
buffers are on their notes. So we were very accustomed to higher buffers or higher barriers than that what was currently in the market now. Like if it goes down to 20%, we're not really a big fan of using those. We would rather use things that are heavier protected on the downside in those kind of notes. So as those kind of started to become more sparse, we kind of deviate away from them, and we'll wait for those opportunities to come back to them when we see that there's a better fit for us to use them.
So presuming that that's tied to when interest rates started to shift and come lower, and just
Uh,
the shifts in the yield curve change the time value money options pricing, that starts to shift the buffers and barriers in ways that were just not as compelling for
Uh,
you.
exactly. And that's what
Okay.
that's when we started. We evaluate them, we review them constantly. But when we find a fit, we know what space they fit in our clients' portfolios, and we know what specifically we want. And when we see it, we will act on them. But if we don't see them, we won't. And they're all fee based as well. So they're, as you know, that you can have them commission or fee based. We do all our notes are fee based. Um, so and then
So,
yes, sorry.
oh, no, so structured notes were getting sourced more on the Halo side for their platform. So I guess, how are you managing access to some of the others, to private credit, to private equity, to hedge funds?
Yeah, so private credit, we use a variety of them. There's Blackstone private credit that we have used. That's probably one of the more common table stakes one out there that a lot of people know about. There's Blue Owl that that's out there that people probably know about as well. There's FS credit. There's a handful of them that are out there that we use, and then there's a few that we're vetting that have approached us directly or through Summit that have asked us to take a look at them, and then we'll review them to see if there's a fit on our platform for them or not. And then, if you go look at the REIT space, like if there's a REIT need, then we'll look at the different REITs. Some clients, when they come to us, we evaluate what their portfolio has. If they have REITs in them, then we're kind of evaluating should they keep them or not. If we have clients that we want to do a percentage allocation to REITs, then we'll look at the REIT opportunities there. But I would tell you that, and then if you look at the a space where like there's private equity or private placements, then there's opportunity there. And those are for the clients that would probably have in excess of over 20 million with us, where they might have like a legacy bucket for that. They know that they can tap it, but they're probably going to be leaving that to next generation. Some of those things have 3 to 5 year holds. Some that they might have a little bit longer than that. There are some different packaged types of secondary private equity offerings that are available that might only have a 1 year hold. So we look at the different options and see what the right fit is for the client.
So it sounds like for a lot of these, you're going directly to providers. So you're going directly to some of the PE placements, private credit, like you're going directly to Blackstone or Blue Owl. So does it mean, are you not a user or of the, like the alt platform folks? So like the Case I
Yeah,
Capital, those folks, or do
actually,
you still do it through them?
for some of them we'll go direct. For a lot of them, we are using Case and iCapital, honestly. And when we use them, we will still go direct and have our conversations with the institutions directly. If they're available on Case and iCapital and we're not doing enough volume for us to do direct, and we're getting a better price point, we'll use Case or iCapital.
Okay. So is that kind of the defining factor for you? If I have enough volume that I can go direct and get reasonable pricing, then I'm just going direct. If I don't have enough volume to go direct, then I'm using Case or iCapital as a platform access pathway.
Yes, yeah. Our goal is once we find the right fit that we're going to use for our client base, we want to get them the best pricing possible as well, built into the ecosystem,
Okay.
internal pricing. So yeah, we'll look at that. But Case and iCapital do a great job, and in my opinion, of using a layer of secondary review of these investments in the alternative world. So just having that next set of eyes and diligence, I think, is important sometimes to really kind of hone in on, what's working, what's not working. And I also think, as we spoke briefly about how should advisors kind of approach the alt world and kind of get into it, reaching out to their case and iCapital representatives and their Blue Owl and Blackstone representatives, and having their wholesalers help educate the advisor or their advisory teams a little bit on the different services and products that they have is a good baseline or foundation of setting yourself up to kind of go to the next level. They all have these universities of education, right? Obviously, the end game is the more advisors they educate, the more probability is they're going to be using their products, correct? So I say that that's a great platform for advisors that are saying, I want to learn more about this space. How do I learn more about the space or the all AI kind of universe as a whole? Start with the wholesalers and their firms to get that education. Once you start getting that foundation of what is private credit, you can start then diversifying out and say there's 5 of them out there. Which one's the right fit for me?
Uh, and so are there other platforms that you typically use besides KSI Capital for credit and equity, Halo for structured notes? Or is that kind of your main go-tos?
We use CAS, Opto, kind of some other options out there.
And in the end, are there typical allocation percentages that you get? Is there I don't know, how much at least do you want to see clients in alts? Is there a max of beyond which you don't want to see
Yeah,
clients in
yeah.
in alts? Like what are some of the parameters in practice?
Yeah. So, I mean, the baseline is really, if you really look at these endowments and foundations, obviously they have a tremendous amount of capital, but they don't need a lot of liquidity. And a lot of them have, in the mid 30% range in the private investment world. So if you kind of think about the institutional market and the performances that they get, our goal is if we're going to start a client with alternatives, our goal is to get them started at a 15% number in their portfolio, and then we do go as high as 35% depending on the client and their circumstances.
Okay, but it sounds like per the big conversation at the beginning, uh, there's a lot of latitude about which alts or which alt sleeve they participate in to get there. So I don't know, if I've heard bad things about PE and I don't like it, but I think the private credit sounds neat, we may do more of it on the fixed income side or vice
Yeah,
versa if I don't like the credit stuff, but private equity sounds cool because
yeah,
I made my money in a private equity funded firm and they
yeah.
did well, so I want more of that.
So I think, Michael, one of the things that I've learned doing this for so long is if they had a bad experience before, it might have been a miscommunication, a lack of education, a lack of financial, knowledge base that they didn't get the education on. So as we build the report for clients, and they sometimes come in and say, I don't want to see this or I don't want to see that, it's been pretty frequent when we come back to that after a period of time working with a client. They're like, so, I told you before I didn't want to do that or this, but what's your opinion of that? And I explained to them why we use it and how we use it for clients and what our experience has been. And I walk them through and says, have you had a bad experience in it before? And there's a lot of times where the client will want to circle back on things they've said I don't want to do, to like, okay, well, I've understood a lot more of now what the private market world is. I understand how it works. I've seen it kind of happen in my portfolio. I agree with you that we should go from 15 to 25% now. And I'm more open for you to share with me like some of the things that I asked to be off the table now be on the table. That's a very common conversation because I think to me, it's kind of like you set these foundational platforms of education about different things, private markets being one of them. And as they trust you and you educate them and they see that you're taking the time to do that, and now they feel like that base has kind of been met, what's the next level? Then you start talking about the next level and they kind of understand that to be something that they want to go into. And what we do is we host events, and so we bring private market investment speakers in, and we'll have 2/3 usually of clients, 1/3 prospects in the room, and we keep them small, under 30 people. And we encourage communication between the people that are in the room, and then we have a speaker to talk to them. And that kind of draws out a lot of these questions about, well, I never liked this, but why do you think it's, and then after those, we call every client and every prospect and say, what did you think? What did you hear that was different than what you may have heard in the past? And we kind of, dissect those conversations a little bit.
So so then share with us a little bit more how you handle the due diligence of all these different products and platforms and vehicles.
Yeah. So in our immediate team here locally, it's tasked to my other advisor on the team. His role is to really do the very nitty gritty, get the baselines. We do a quarterly review on all the managers and all the investments that we're using. Speak to the managers. You know. You bring in the wholesalers if they have value add to the table. We really don't care about bringing in a lot of people and having a lot of lunches. We really care about having the conversations with the people making the decisions. We leverage our back office. We talk to our investment committee at Summit and see what they're seeing and what their due diligence have been on these investments. We'll talk to Case and I Capital if they're on their platforms to make sure that they're doing their diligence, and if they're seeing the same things we are. And we're concluding to make sure, like, are we still with the right team doing the right type of business for the right products? So there is some diligence that's being done there, and it's being done predominantly by the other advisor on my team.
So how much do you worry that, or just that something blows up, that there's stuff in there that you missed or weren't able to get to in the diligence process?
I think as an advisor in this ecosystem, you're worried about that constantly, whether it's a alternative investment or even an equity, right? So we've seen equities blow up in the past. We've seen things come out in all different. So our job is to make sure that we ask the questions, the hard questions, keep diving, keep making look at different ways to see who the investments are being looked at. Leverage our CFAs in New Jersey to see what they're seeing. Ask the questions from our colleagues over at Case and iCapital, and ask direct questions and have direct conversations. And on occasion, we actually go and visit these investment firms as well. But we do, I think, a very good job of our due diligence to make sure that we're either accepting someone into our ecosystem or keeping them in our ecosystem. And we have had cases in our past where there was a manager change on something, and they called us and said, "Hey, this is what we're doing." And we did a background check of the manager that was supposed to be coming on as the lead, and we got out of that investment immediately. And slowly after we found out, the next year and a half, they bled out that portfolio because it wasn't the right fit for that manager with that style of investing. So we're not sitting on our laurels looking for just, how do we bring in the new client? We have to take care of our current clients, and they trust us to make, help make good decisions. And the good decisions have to have good data. So we are very meticulous about our data and our fact finding to make sure we're with the right places. So I think we do a good job of making sure we're doing that due diligence behind the scenes.
So in practice, like, how many different products or vehicles are on the list uh that you're trying to monitor in due diligence?
Yeah. On any given list, we have 12 to 15. So it sounds like there could be a whole
Okay.
lot more, but I think it's impractical to have a list of 50, right? So if Summit
Right.
comes to us, or Case comes to us, or ICAP comes to us and says you should look at X, Y, or Z, or another manager comes to us, if we already have a good solution that we've gone through the ringer with, we're not just adding other
Yep.
managers on for no reason. There has to be a reason we add another one on. So we have kind of our platform that we will work with, and we have the products on that platform that we're doing heavy diligence on. And I think it's a robust enough platform for what our needs for our clients are. But we also know that, with every new relationship we take on, there's a process that has to take place. And if we need to bring on another one, we will. But we say no more than we say yes.
So as you reflect back on this journey, what surprised you the most about building your own advisory business?
So when I went independent on May 7th of 2021, and left the became an RIA, I think it took me a while to fully embrace the word freedom. Um, and when I say the word freedom, because we always ran our own teams when we were in the wirehouse world, but you didn't have freedom. How do I define freedom? Right? There's a value of this RIA that's on my balance sheet now. When I was at the wirehouse, I ran a business, and I built that business, but it wasn't my business. It was that firm's business that I was babysitting, growing. I kept 45 to 50% of the economics, they got the rest. This is now a freedom of how do you want to grow, who do you want to work with, how do you want to work with them. I choose to price this way, I choose to educate on this way, and having a support system in place, meaning Summit in my back office, rather and a partner rather than a firm that I'm working for. To me, there's so many components of freedom in the word definition that it took me a while to really embrace. And I think it took me about a year and a half to really kind of get it. But when I was introducing and asking our clients, what we're doing and why we're doing it, a lot of them are business owners. And even if they're physicians or periodontists or dentists, they still run
Yep.
businesses. And I think so many of them knew me for so long. And I was always kind of this nervous Nelly, like, what are they going to say? What are they going to do? And we had our kind of like, here's why we're going independent. Here's the fiduciary. Here's the transparency. You know, at the end of the day, a lot of them started laughing. They're like, it's just about time. I'm like, what do you mean? It's about time. They're like, it's about time that you run this the way you've been running it. And all the things you say to us make sense, but we've seen that in you anyway. So it was very surprising, when we moved, we invited 97% of our clients to join us, and within 6 months we were at about 115% of assets. And I think that goes to the fact of the people we work with, the relationships that we've made, the hard work of doing a lot of the education early on to solidify the conversations and the trust that we had. And they know that basically they come to us with anything and everything, and we either can provide it or we find the right place to help them get it. So I think it was a really good transition in the sense of moving. So.
So 115% of assets, like ultimately clients brought more when you left the wirehouse.
That happened to our surprise, to be candid. And then also, after I went through and talked to every client, I went and talked to every prospect. And some of the prospects came back surprisingly and said, well, now that you're with your independence, I'm more apt because I don't want to work with a wirehouse. I want to work with independent like you are. And I understand that you have custody at Fidelity, but we are ready to work with you. But we didn't want to work with you before because you were with a wirehouse. I
Was
thought
that
that,
a surprise to you,
yeah,
having
I was.
worked in that? I mean, historically, one of the reasons you went with the wirehouse is that's supposed to be an asset, like on your, to your credibility, to your ability to track clients.
Well, I would tell you that growing up in the wirehouse world for almost 26 years, I think it's kind of this theory that you're there, and because you're there, you're going to be able to win clients. I think that's probably some level of transition at some point where you start and then you start building your clients, you ask for prospect. I think going through that model, I think what COVID taught me was the clients are really there for you, and you're the reason that they're your relationship. And you might need a slew of things behind you to service that relationship, but the essence of that relationship is the advisor and the client. And I think that now that we're a few years out of COVID, and now you're seeing all these aggregators and RIAs out there, and now you see the growth of all these RIAs, I kind of chuckle to myself that anyone who's a successful advisor in the wirehouse is most likely looking at the RIA channel very closely to ask themselves, should I be doing something about this or not? Meaning make that move. And I think that because I think 10 or 11 years ago, their option was you do it all yourself or you're in a wirehouse. For the most, that's a very generalist way of looking at things. But now with all of the, supported independence platforms out there, I think that there's a lot of opportunity for a lot of wirehouse advisors to truly make a move and feel like they're keeping a lot more of the dollar that they're generating, that either allows them to build their infrastructure out deeper and have more meaningful conversations with their clients, still making more of that dollar. And oh, by the way, a 1099 as versus a W-2 has a lot of tax benefits. So I think there's a lot of transition happening in our industry. And I think another component to that is the transition of the advisor that's 60 plus and looking for a succession plan that may not want to stay at the wirehouse. They want to move, and then they want to be acquired over a 3-year window and then be gone. But they want to make sure that they get to pick the advisor and the team that will service their clients going forward, because they've built that book and they have personal relationships with those people and they want to make sure they're taken care of. So I think that there's a lot of movement, and there's a lot of opportunity in our world of financial services at this point in the game.
And what about the dynamics of um, having access to these kinds of investments in the first place? I mean, I know one of the reasons a lot of advisors like to be in the large firm wirehouse environment is because of like the access to private investments, the access to IPOs, the access to funds. So I guess I'm just curious, like now you lived both sides, like you
Right.
did alts there and now you've done alts on the other side. So how really does the access compare for you at the end of the day?
I would say it's mind-boggling at the comparison, and I think at the RIA world, you can go out there and say, I want to work with this alt or this investment, and then show the due diligence and do the due diligence, and then have another team do the due diligence for you and say, okay, this makes sense. There was really no recourse of doing that, in my opinion, from my experience in the wirehouse world. It was kind of like, here's your platform, you can use it or not. Whereas again, taking that freedom and that ownership of going out there and saying, what my clients need is X, Y, or Z. I'm going to go out there and seek it out, talk to them, do the due diligence on it, and then go back to our back office and have them do another set of due diligence on it. And if everything checks out, potentially use them on the ecosystem. I think it's just a more robust platform of allowing you to be customized to the clients that you're working with.
So what was the low point on this journey for you?
I think the lowest point in my career overall was when I felt stale. When I was
Mm.
about 2019, I was really wanting to grow by acquisition. I didn't really feel a strong support from the organization I was involved with, the wirehouse I was with, to allow me to do that. I went off on my own and met with 10 or 12 different teams within the same company. And, it seemed like it was there, every office had their own way of doing things, and there wasn't this systematic, like, let's figure out how we can help Manish grow by acquisition. So I felt that to be very, like hitting yourself against a proverbial ceiling there, because we were growing organically, but I wanted to grow by acquisition at that point. So that was one of the components to my decision to want to move and then go independent and want to partner, not a parent per se, watching over and saying, you should do this and we want you to do that kind of mentality. So I felt like I had the aptitude to do it. I had the desire, I had the willpower, I had the motivation, and fortunately I had the team, because the team, without a good team, you can't really do half the things you really want to do. And the team is aligned. That one of the reasons we have a 10 a.m. meeting is to check in on with everyone, see how they're doing, make sure that they're aligned with things that make them happy on the day. If you're not doing more than 75% of the things that you like to do, then we want to see if there's someone else on the team that we can assign that to, or hire another person to have do that thing. So I'm very mindful of making sure that we have a level of quality of what people are doing is happy and they're resonating with that, and they have an ownership interest. I won't hire a new person on this team until my whole team meets them and vets them and gives me their feedback, right? Because they're going to be in the same world then as that person is. And there's been times where I was about to hire an advisor and the team came back and said, with all due respect, we don't see the fit. And so I have to listen, because they know me and I know them, and we've been together for, some of them decades. So, and I want to bring in the right talent and I want the right fit to be there, because at the end of the day, you know, the more successful we align together as a team, the more valuable we will be to our client.
So what else do you know now you wish you could like go back and tell you from 10 years ago?
Yeah. Well, I think I kid and joke, but my colleagues that have all left Wirehouse and gone independent, we all have a kind of chuckle and say, I wish I would have done this earlier. Right. I'm
Yeah.
53 now and I have 20 years ahead of me. And I feel like I did this when I was just about, you know, hitting 50. If I would have done this 5, 7, 8 years ago before that, I think, I always wish and said, that's a regret I have. Why didn't I do this before?
Mm.
But you can't look backwards, and you got to look forwards. I did it. And there's a lot that are considering to do it. And I'm always open to tell people, and I said, call me if you have questions about independence, not
Yeah.
only Summit or Vardhan, but independence, because I don't see anyone else as a competitor. I think clients will resonate to the people they need to resonate to. And if that client
Yep.
doesn't resonate with me and they find themselves with another advisor, that means that advisor was meant to have that client. So I feel very honored that the people we work with have chosen us to work with them. And I continue to feel honored every day when we win new cases because they feel the same way. But I don't think about the clients that said, you know what, I think I'm going to go somewhere else because that's a better fit. Thank you for letting me interview with you.
Right.
I can't, I don't dwell on that stuff. So I think it's always a way forward.
So, any other advice for younger, newer advisors like coming into the profession today?
I think, be mindful of who you want to align yourself with. I think a lot of younger advisors have aligned themselves with teams thinking at some point they'll run that team. But, ask the tough questions, have it be a two-way conversation if you're kind of coming in and looking at teams. There's a lot of opportunity out there for a lot of teams that are looking to hire great young talent that want to have that. But at the end of the day, have grit. Because this is a business where you can learn a lot, but the fear of failure or having that grit to kind of just make that one other conversation or go to those events to try to win and get in front of people with money. Believe in yourself and have the grit. You have the aptitude, you can learn the aptitude, take people if you need to with you to support you, but have that grit and the determination to go out there because this is at the end of the day a sales opportunity, right? We are selling ourselves every day to our clients, to our prospects, to our centers of influence. And we want to put our best foot forward, and our reputation is everything, right? It takes a long time to fill that bucket. It takes a very quick instant to splash it all over the ground of reputation risk. So treat your reputation and covet it because that's the only thing that you really have right now in this business is your reputation.
So, as we wrap up, this is a podcast about success. And just one of the themes that comes up is literally like that word success means very different things to different people. And so, you're on this wonderful path of success with the business as you're crossing 500 million and picking up the inflection point of growth. And so the business seems to be in a wonderful place now. How do you define success personally for yourself at this point?
I define success personally for myself as mental happiness for my family. I have a beautiful wife and three great kids, and I feel that the healthier I keep myself, the more mental stable I keep myself. When I'm present at home, I'm present at home, so I can make sure that they have what they need to be thriving 13, 16, and 18-year-old young men and to support my wife and her own journey for happiness. So to me, happiness is defined by making sure I have the best self I can be so I can provide that to others. If I'm not the best I can be, I can't provide the best to someone else. And I feel the same way about our team and our clients. So that's where my value kind of lies in is really make sure that you take the time to be grateful, offer gratitude for what you all have, offer, be mentally fit, work out, train hard, have time for your socialization and your family. Always important. I try not to miss any significant things that are happening in my kids' lives for work. I think it's at the end of the day, if you miss a conference or you miss something, it doesn't matter in comparison. If you missed that one tennis tournament or that one banquet that you missed for your child. So I'm very mindful of making sure that these kids are young once and they're mine, and I want to be present and available for them in whatever way they want me to, and I can be. And I'm fortunate that they want me. As teenagers,
Yeah.
sometimes it's like, Dad, you just drop me off at the curb and I'll be fine. Kind of mentality is not there in our house, which I'm grateful for. So to me, I try to be physically fit, eat well. I feel very mindful of those things more now as I'm over 50 than when I was in
Yeah.
my 20s or 30s. But you know what? I don't have a dungeon. I laugh when people ask me, "What do you mean a dungeon?" I don't, you know. I let things roll off my back. I don't have, I'm not upset at people. I feel that people have their own journey that they're on, and I don't know what their journey, where they are in their life and their journey. If I can be helpful or meaningful in any way, or I will. And if they don't need it or want to reciprocate, I don't let it bother me anymore. So to me, it's kind of like let all that stuff go, let the baggage go, and just enjoy what you have. I think a lot of advisors who listen to your podcasts are very successful and on a journey to be even more successful. But don't let that success get in the way of the things that are really valuable in life, and that's your family.
Amen. Amen. Thank you, Monish, for joining us on the Financial Advisor Success Podcast.
Thank you, Michael.
Want even more ideas, tools, and resources on how to break through to the next level of success as a financial advisor? Check out the leading financial planning industry blog, Nerd's Eye View, at www.kitsis.com, where Michael covers the latest practice management trends and financial planning strategies. And by joining the members section, you can earn IMCA and CFP continuing education credits, along with exclusive member content. Get it all now at www.kitsis.com.